Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula. Registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC.
Hope you're having a great day out there. We want to thank you so much for joining us, spending part of that day with us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. 419-794-3030 is the phone number. Once again, that's 419-794-3030, online, arhq.com. My name is Chris Swan. Today on the show, is the 401k our best bet to save for retirement? We're going to talk about what could happen if Congress continues to kick the Social Security can down the road, and how to detect junk fees in your retirement portfolio. All this and more. But first, let me check in with the man himself, Nolan. Glad to be with you as always. How are you, sir?
Doing great. Just enjoying summer. We've got a lot of fun things going on. Actually, last weekend we had our first high school hockey tournament, which was over at Tam O'Shannon. Pretty fun. Our son plays for Anthony Wayne, and he's going to be a senior this year. And it's pretty cool to see him develop throughout the years and go out there and get some goals and, be able to catch up with some of my hockey family, and looking forward to the season. But hopefully it doesn't go too fast. I'm enjoying the summertime. And, when hockey gets here, that means cold weather is here to stay. So let's just continue to enjoy some warm weather while we can.
Definitely enjoy what we've got while we've got it, and not to speed up the process by any means. Although you've been through it before, with this being a senior year, once hockey wraps up in the winter, and then it's making that transition from high school to college and that adjustment. And so there are people out there who maybe are getting ready to make the adjustment from the working world into the retirement world. And, just a reminder, it could be here before we know it. So there really is no time like the present to go ahead and begin that planning process. And it all starts, like I said, by going to the website, arhq.com, or giving a call, 419-794-3030. But let's not focus solely on the future right now. That is a major component. But let's talk about what is happening right now. And the fact is, the stock market is up. So guess what story is back? Quote, there is a new record of 401k millionaires. Perhaps you fall into that category out there. And if so, congratulations. But here's the thing. Now what do you do? What are you going to do about it? Do you keep putting money into the market, or do you take a profit and put it into a less volatile place in the stock market? Nolan, if people are coming in and they have these questions for you, should I keep writing this and making the most of it? Or should I go ahead and take some of that off the table? What are you telling them?
Well, here at America's Retirement Headquarters, what we really try to focus on is those folks that are in what I refer to as the retirement red zone. So folks that are 5 years before retirement, or, have retired within the last 5 years. I think, when you look at the current market conditions, that's where it becomes much more relevant for families. And the reason being is when you move from savings and accumulation. So my son, who worked here at the company, he's 21, and he's been putting money into the 401k. And, whether the market goes up or down in the next year really has almost no impact on him. And if you look at, the sequence of returns of when the market goes up or down, for somebody who's a saver, it really doesn't have a big impact. But when you get close to retirement time, major losses right before retirement can derail your retirement plan, as well as the fact it's even worse when you've made that decision to retire and now you're taking money out of your retirement plan. And if that money, is in a volatile spot with the stock market at record highs and the market has some type of major sell-off, that sequence of return, those big losses right away can kind of hurt you. What I'm telling people to do right now is what I would tell my kids when they were little, and I go back into, elementary school or, even scouts, and that's to run the fire safety drill with your portfolio. I am so happy to see that the markets are up substantially here in July of 2024 this year, and I hope the markets continue to go up. I do believe that the market risk is somewhat elevated. We have a lot of things that are going on right now. You've got a former president who was almost assassinated recently. We've got the election coming up behind that. You've got markets at record high. You've got geopolitical uncertainty overseas. You've got, underlying recession fears. Inflation's the real deal. There's a lot of turmoil that's building up. So for those folks that are getting closer to need that money, taking some steps to kind of protect their pockets and their profits is probably a good idea. determining whether your portfolio is too risky at any given point involves considering, again, multiple different factors. So in the example that I gave a minute ago, my son at 21 is very different from somebody who's at, say, 60 or 65.
Sure.
When we look at it from a financial perspective, when we're making decisions as we look at things on our investment committee meetings that we do every month, we're looking at things like the economic indicators, we're looking at market volatility, we're looking at those geopolitical events, and we're, then evaluating somebody's individual risk tolerances. One of the things that we do for all of our clients is we develop what's called an investment policy statement. And within that investment policy statement, what it'll do is it'll help us determine, within a 6-month time frame, what the likely outcomes could be in the portfolio if the market continues to perform well, and or if the market has normal market pullbacks. That coming up with that helps somebody determine what their overall risk score is, and we can measure risk in this case anywhere from 0 would be like having your money in the bank to 100, meaning investing in something ultra high risk. And so we can then go through a series of questions with somebody, and we can ask them, well, how do you feel if this happens? Or what does it look like if this is the outcome? Would you pick this investment or that investment? It's kind of like going to the eye doctor. And the goal is to get, 20/20 crystal clarity on what the vision looks like within the portfolio. And by going through that independent portfolio analysis, what it allows us to do is it allows us to say, does your portfolio line up with who you are and what you're comfortable with? So if you're invested into the stock market, whether you have a 401k or you're a personal investor and you have more than $250,000 of investment assets, we would be happy to do an independent portfolio analysis for you, give you our feedback on where we would see, maybe some strengths in the portfolio, if there is any areas, maybe areas for improvements. We'd be happy to share, again, more information about what we think about with the market being risky right now. Again, we'll talk a little bit about interest rates. It's my opinion that interest rates are probably going to stay higher for longer. I would agree with that term. But overall, I do feel that interest rates are probably going to go down at some point in the future. Mm-hmm. So locking in decade level high interest rates and some of the products that are out there, could make a lot of sense. Inflation, factoring that into your portfolio, I think inflation is going to be here for a long time. I would expect between now, middle of the year, and end of the year, I would not be surprised if we saw some significant increase in market volatility. That being the VIX index is called the fear index. And, volatility creates uncertainty, which sometimes can create panic for people. And if you panic in a situation, those are the type of investors that typically get hurt. But if you've run this fire safety drill and you know what the plan is, volatility actually can create opportunity. They say that the past never repeats itself, but I also say that history oftentimes rhymes. And so when we look at it, I would say with the markets at record level highs, again, depending upon what index that you look at, for the most part, a good majority of the indexes are at record level highs, driven by a small group of individual stocks that are pushing that index higher. You've got to be a little bit careful with what you own. There are some investments that I would consider to be risky right now. I do have concerns about some of the geopolitical risks that we have, with the global conflicts that we have, even in Russia, Ukraine, how the elections could impact the different trade policies. I think whoever is the ultimate winner of the election, I think is going to have a very clear difference in what their trade policies are based upon the U.S. Or international. You want to pay careful attention to, what the corporate profits are of companies. One of the stats that I talked about is a little over 40% of the companies right now in the Russell 2000, which are small companies, are unprofitable. Generally, I think, I get concerned about companies that are unprofitable in this type of environment and how those are going to perform, when we do have a recession or we do have a pullback in the market. So owning quality companies, knowing what you own, and then you take that and you apply it to your individual risk tolerance. So, just because you're golfing with some friends or you're playing poker or get some advice from, some friends in your social group, what's right for their situation may be different from yours. And so figuring out what's right for you, again, comes down to talking about your goals and objectives, looking again at having that independent portfolio analysis so you can evaluate, what your risk tolerance is, applying that to how your investment horizon is, understanding if there are things that you want to do to have some downside risk management. What are the steps that you can take to still try to participate if the market goes up, but maybe limit losses when the market goes down? We have a lot of those topics on our YouTube channel. So anybody who goes to YouTube, just type in America's Retirement Headquarters. You can see different topics that we give you specific advice on, ideas to implement for downside market protection. But in conclusion, the best thing that you can do, again, is if you have more than $250,000 of investment assets and you have that money in a 401k or an investment account, give our office a call. We'd be happy to provide you a complimentary investment portfolio analysis, give you feedback to help you address that question, help you run that fire safety drill before the economy catches on fire.
That's right, and better understand your volatility, what you're comfortable with as far as your risk tolerance goes. It's probably going to be not going to be 0. It's not going to be 100. There's obviously 99 different variants in there, but finding out what's going to work best for you. The growth potential in the market can't be understated, but also knowing that, if we saw a 10, 15% pullback and you're heavily invested, it could be detrimental, could possibly be devastating to your retirement. So you got to find that Goldilocks approach, what's going to work just right for you. That is where that independent portfolio analysis comes into play. That starts with a phone call, 419-794-3030. Schedule a time to speak with the guys at America's Retirement Headquarters, or go to the website and you can schedule a time, find out more about them there as well, arhq.com. The clock is ticking on the so-called Trump tax cuts. They're due to expire at the end of 2025. If you want to take advantage of the lower rates now, you can do a Roth conversion. The money does go in after tax, but tax guru Ed Slott tells Morningstar many are skeptical because they think the government will try to tax Roths next. And here's what he had to say about that.
I'm going to give you the secret that Congress doesn't want anybody to know. Don't worry about it. Congress loves Roth IRAs. I mean, loves, addicted, that kind of love. It brings in money. It helps pay for everything else. So luckily for us, they're so short-sighted. Remember, the only money that can get in a Roth is already taxed money. So they look at the Roth IRA as a revenue source. So I don't think they're going to kill their golden goose.
Normally, I'd be wary if someone was talking about a politician and some form of addiction. But when it comes to tax savings, perhaps there's some merit to that. Would you agree? How much of a retirement nest egg should be converted to a Roth prior to the end of 2025? A portion of it, or maybe even all of it?
Yeah, I think Ed Slott actually has some really good advice there. I've seen him in conferences, read some of his books, listened to his audio tapes. Ed really does traditionally have some good feedback, and I think he's correct in the fact that, when somebody takes money from a tax-deferred IRA and they convert it to a Roth IRA, in that year is when taxes are typically due. And we know with most of our politicians, they're concerned about the short-term here and now. And so getting that revenue in, I think what Ed, talks about makes a lot of sense on why politicians would like that money now, not thinking about things in the long run. The first thing that I would say is, I'm not a CPA. I'm not an accountant. Before you make any financial changes to your portfolio, it's always important to sit down and run the numbers with your CPA. I know our office, we work with a lot of different CPAs. And when we look at creating a tax roadmap for somebody, getting the CPA involved in the conversation is very beneficial. Mm-hmm. It gives that opportunity to maybe think about things and get everybody on the same side of the page. That's why we like the comprehensive approach that we do to have, all the key professionals working on the same side. With tax season kind of filing behind us, if you will, now that we're summertime, we're thinking about, okay, even though your tax filing is put away probably for last year, right now is a really good time to do a tax analysis and create a 2024 tax roadmap. With a 2024 tax roadmap, what we can do is we can go through our tax savers checklist. There's 25 different items that we go through when we're looking at the tax roadmap on ideas to share with people on how we're looking to try to minimize the taxes that they pay either this year or sometime in the future. And if you don't have a 2024 tax roadmap, I would encourage you to call the office at 419-794-3030. 30/30, we'd be happy to do that for you. Get a tax analysis. It's really beneficial if you have more than $250,000 saved in a tax-deferred retirement account, especially if you think that the tax rates will be higher in the future. And, with the out-of-control spending that we have and with the looming tax cuts that are coming, I personally believe that for a lion's share of the majority of Americans, tax rates will be higher in the future. So in many situations, again, not in all situations, but in many situations, converting money to a Roth IRA, either a portion of all of it, is somewhat of a plan that oftentimes happens over a couple of years. I'm going to give you two great ways to do it. But first of all, you want to think about the factors to consider when you're looking at doing a Roth conversion. What you want to do is you want to look at your current tax bracket. So converting money to a Roth IRA is going to be a taxable event. You want to assess your current tax bracket, consider like how much income you have to stay in the same bracket, or if you go up to the next bracket, where those income levels are, how much additional income you can handle without pushing yourself maybe into a higher bracket. You want to think about what the future tax rates are going to be. So we kind of know, unless there's some change to the tax law, what the future tax rates are going to be after the current tax laws expire. Take it into consideration things like required minimum distributions. If you're reaching the age where you need to take required minimum distributions, currently at the age of 73, converting to an IRA or a Roth IRA can reduce the RMD amounts because money in a Roth IRA doesn't have to take RMDs. You want to look at the availability to fund to pay the taxes. When you do a conversion from a traditional IRA to a Roth IRA, you usually do have the ability where you could have the taxes withheld from the conversion amount. So again, if somebody converted over, let's just say $10,000, they could have $3,000 held for federal and state taxes, and the remaining $7,000 goes into a Roth IRA. The best bang for the buck, in my opinion, is when you're looking at availability to pay for the taxes, would be to do the conversion, try to get the full $10,000 into the Roth IRA, if that's the right number, and then pay the taxes from personal savings. That way you've got the bigger use of the tax-free money working for you. Mm-hmm. And if you want to develop a plan to help keep the government away from your money, looking at it and developing a tax roadmap can be great. We'll look at it from a strategic standpoint. The second area that I want to talk about is what is called tactical. And what tactical means is when's the right timing to do a conversion. So from a tactical perspective, I don't know that right now is the best time tactically to convert over equity positions in a portfolio. And the reason I say that is that, the market is right now at record level highs. And so with the market at record level highs, it may be better off to wait until there's a pullback in the market from a tactical perspective. So if you have great stocks that you love and want to own for the long term, and if there's a market sell-off, great companies will probably be worth a little bit less if the market has a sell-off. Doing the conversion at the lower amount gives you the ability to maybe have a big bounce back. And if it's in the Roth IRA, you get the bounce back in the Roth IRA, as long as you follow the rules of what is set up for a Roth IRA. Then all that tax-free growth and that bounce back is also tax-free. So, from a tactical standpoint, maybe not the best time, but from a strategic standpoint, looking at it every year. And again, the best and only way to figure out is to work closely with your accountant, CPA, and have our office put together a 2024 tax roadmap for you.
Having a methodical approach about it, that tax roadmap run is a great way to start and figure out how to make sure you get to keep as much of your money as possible. Reach out and speak with the team at America's Retirement Headquarters, 419-794-3030. You can also schedule a time as well on the website, arhq.com. It's kind of hard to believe it's almost August already, but an article I read points out that before the year gets away from us, summer is actually a really good time to have that mid-year financial checkup. So, Nolan, what boxes would you check off during this meeting?
Yeah, I think, having a summertime financial checkup, it's kind of like going to the dentist. They recommend every 6 months. And coming from a family of dentists, I think that's a good idea to get a summertime financial checkup. This year is a special year. We've got a lot going on with the elections, with that market, where we're at in the market cycle. You've got strong run up in equities, maybe a good time to kind of rebalance things. What we do when we do a financial checkup, if you haven't had a financial checkup by our office, what we're going to do for you is we're going to put together the retirement team action plan. So that financial checkup in the retirement team action plan, we're going to spend the majority of the time talking about your individual goals and objectives. And then what we're going to do is we're going to collect a lot of the analytical data, meaning your investment statements, taxes, we'll look at insurances, estate plans. We'll take all that information, we'll write up a summary of observations for you. The team, what that stands for is the fact that here at America's Retirement Headquarters, we take a team approach. We have, multiple qualified professionals that we all work together to provide a comprehensive solution for the clients that we work with. But the team also stands for taxes, estate planning, asset protection, and money management. So in each of these areas, when we provide somebody their written retirement team action plan, we'll go through each of these sections and we'll talk about, here's what our observations are. One observation could be maybe with the markets at record level high, what their risk score is. While the markets are record level high, we would talk a little bit about things like what is your exit strategy or what is your downside risk management program if and when the market goes down. When we're looking at things like taxes, we're saying, how do we create a tax roadmap? What is the distribution of your money between taxable, tax deferred, and tax-free accounts? When you're taking withdrawals in retirement time, how are you taking those withdrawals out? Are you taking money from your taxable? Are you taking money from your tax-free account? Are you taking your money from your tax-deferred account? Looking at the distribution of your tax plan. When we're looking at insurances, we're looking at the areas, things like, what happens to protect your surviving spouse in the event of a premature death. That could be reviewing things like your life insurance needs. When you retire, oftentimes your group work life insurance ends when you retire, but that means, protecting your surviving spouse, that need doesn't necessarily go away, and protecting the loss of income from like a premature death of Social Security can be an important consideration. When we're looking at things like your asset protection, we're talking about the areas of how to navigate the landscape of affordable health care if you retire before the age of 65. And it's an income, not an asset test, meaning that how you take distributions from your retirement account and or when you turn on Social Security will impact the cost of what your health insurance is pre-65. As you transition to age 65, having that checkup annually of looking at, Medicare, the supplement, the Advantage plans, and the differences. In 2025, I know they're already looking at a lot of the different plan changes that are coming up, all the way down to looking at the end, figuring out if you or your loved one slow down, you need help with long-term care. What are the ways to protect your assets without maybe necessarily spending money on traditional use it or lose it long-term care insurance? There are other solutions that are out there, but while you're young, those options are much more available than waiting until life and later on, especially, when somebody has a health situation, their options may become more crisis type planning. From a estate planning perspective, number one, making sure that you have your estate plans in place. So that could be a will, a trust, that could be supporting documents like your living will, the power of attorneys. If you don't have those, getting those in place. Maybe if those are documents that you haven't had updated since the kids were little and now you're a retiree. Again, revisiting those plans and putting all those things in place. Now, that's something, our retirement team action plan, that's complimentary. So if you have more than $250,000 of investment assets and you're looking at, it is summertime and I'm willing to commit a little bit of time. And I know you got to get out of the sun, but let's pick a rainy day. Come on into the office. We'll put together a retirement team action plan for you. We'll share our observations with you on, ways to kind of improve the situation when we look at your taxes, estate planning, asset protection, money management. All you have to do is just give us a call at the office and we can put together that retirement team action plan. And that's one of the things that you can then check off the list. And, for those of you that are maybe a little anxious about the economy, maybe you're a little bit worried about, do I have enough money? Maybe you're worried about, should I make a change to my portfolio before the election happens? And maybe you just need a second opinion. Maybe you're not sure if the plan that you have is in your best interest and you want to get a second opinion. you're the type of person that should give us a call and go through that retirement team action plan. It's complimentary, and we'd be happy to do that for you either in person. Of course, we also offer Zoom calls, and we can do it right over the phone as well. Happy to help out.
All it'll cost you is your time, and I dare say some of the most valuable time you could be spending this summertime, and perhaps you just want to go ahead and get out of the sun. It is get warm out there and enjoy some AC or what have you. 419-794-3030. Great time to take a snapshot, see where you stand as we head into the second half of the year, and if there are changes that need to be done, being able to do so before it becomes a much bigger problem down the line. That retirement team action plan, as Nolan pointed out there, complimentary to you. 419-794-3030. Or visit the website, schedule a time there as well. It's arhq.com. Now, a stock market bubble is something that happens when share prices increase rapidly beyond the value of companies. Financial author Harry Dent tells Fox Business, we've been experiencing a run-up that, quite frankly, might burst pretty soon.
This bubble's been going 14 years instead of most bubbles 5 to 6. It's been stretched higher, longer, so you'd have to expect a bigger crash than we got in 2008 to 9. This thing has got to blow. It's showing signs of topping here, but we've got to see a crash of about 40%. I can tell you there has not been one bubble, and this is far larger and longer, one major bubble in history that has not ended badly, period.
That doesn't sound very positive. Now, when bubbles do burst, a lot of investors, quite frankly, they're caught off guard. How do you guys help prevent clients from becoming victims of a bubble?
Well, I think it's definitely running what's called the fire safety drill. Now is such an important time to be running the fire safety drill before something bad happens in the stock market, and understanding not only what you own, but understanding what is your downside risk management program. Now, I was blessed a couple of months ago where I had an opportunity to go out to Yale and interview a couple of professors at Yale, William Getzman and Roger Ibbotson, and get their opinion as far as the outlook of the market. Now, also at Yale is Dr. Robert Shiller, and he's famous for creating what's called the Shiller PE ratio. And so if you look at his PE ratio, what he shows is that the valuations in the market today are actually higher than where they were right before the crash of 1929. So you've got, a lot of the people that are, like Harry Dent talking about the bubble will burst. And I think at the end of the day, they're all right. The bubble is going to burst. The question becomes, when is that going to happen? On the flip end of the scale, it was last year. And last year, I remember somebody had come in from one of our financial talks that we had. And he came in and he had shared with me that after the volatility last year in the market, he took all of his money out of the stock market and moved it into bank CDs. Now, bank CD rates are some of the highest that I've seen in 20 years. But the problem by doing that knee-jerk decision of getting out of the market is, he's missed out on such a huge rally that we've had overall within the market. So making that emotional decision is going to be painful. And in fact, whether you listen to, Harry Dent, myself, or anybody else, everybody's willing to give you their opinion about when the market's going to crash. But you have to realize the market doesn't care what my opinion or anybody else is. The market's going to do what the market's going to do. Mm-hmm. And so if we go back and we look at, things in the past, I've been licensed in this industry for 30 years now. And if I think about different market cycles, there can be things that happen that dramatically change the market. So, we saw COVID happen, and, COVID showed that the market could go down the fastest it ever did in the history. We saw 9/11. The market immediately collapsed from that. Then we saw other market cycles like the dot-com bubble burst that lasted a couple of years. 2008, that was started in 2007 and went through 2009, a little bit more of a longer cycle. And what I want you to do is I want you to make sure that you understand the market's at record level highs. I'm not saying it's time to panic. I don't want you to panic. And the reason I want you to be prepared is I want you to run the fire safety drill while times are good. That way you know exactly what the strategy is if and when times get bad. There's 4 things that I want you to do. Number 1 is I want you to protect profits and reduce some of the amount of money exposed to market loss. When you look at rebalancing your portfolio, what you traditionally do is a lot of people have money either in equities or fixed income. So we've seen equities rally very strong, and we've seen fixed income mainly the bond fund market, to be either flat or slightly negative. So rebalancing your portfolio means selling off some of your winners and buying some of the things that are a little bit lower. It's contrary to what emotionally you want to do. You'd be like, well, why would I sell the things that are doing good and buy the things that are down in price? Because in fact, what you're doing is you're doing the right approach of overall investing, I believe, to help with risk reduction, which is selling high and buying things that are low. It's, again, from an asset allocation standpoint, doesn't guarantee success in the market, but it is a strategy. You can also protect profits, meaning that there are investments that you can take and put money into things that are not exposed to market risk. So in this case, you could take a percentage of the money, you can put it into where we see the high interest money market accounts. Again, FDIC insured bank CD rates are good. A lot of the fixed and index annuity rates are some of the highest rates that I've seen in 20 years in the industry. And by doing that, that's going to ultimately give you some money that's not exposed to market risk. Depending upon what type of an investment that you put it into is going to give you purchasing power. So if and when the market goes down, you have the ability to have some money that you can buy back in, again, depending upon what you put it into. The second thing is you could utilize what we refer to as circuit breakers. And some of the models that we have here at the Retirement Guys formulas, what we do is we take a look at the moving averages of the market. And based upon where the market is at, as long as we're above the moving averages, that would be an indication that, things have relative strength. Technically, things are still strong to either stay or get invested. And then when the market goes below a moving average, that would be an indication where one of our circuit breakers goes off, designed to kind of help protect and try to limit losses by reducing your equity exposure. Most of the people that I meet with that either aren't working with a financial advisor or working with a lazy financial advisor are put into more of a set it and forget it type of an approach. And by that, what I mean is in 401ks, when you have a target date retirement account, it's essentially like putting your plan on cruise control and going the same speed all the time, regardless of what the market conditions are. When you're talking about circuit breakers, what I'm talking about is adding in what I would refer to as a gas pedal in the plan. And so what the gas pedal does is it not only looks at things from a strategic standpoint, it also is going to look at things from a tactical perspective. And it's going to say, based upon the market conditions that are out there, when the market conditions deteriorate, it's going to let off the gas pedal. So instead of going 75 miles an hour, you're going to begin to slow down, and it's going to help you kind of reduce that gas pedal maybe down to, 35 or 40 miles an hour. And in terms of driving a vehicle, if you're driving a vehicle 70 miles an hour and you get in an accident, it can be deadly. The same would be true as if your portfolio is invested at a 70 level risk and we have a major economic downturn. I mean, Harry Dent said 40%. That's a huge downturn in the market. Mm-hmm. That could be deadly for a retiree. Where if you had the circuit breakers and you had the ability to slow down your portfolio to, say, 35 miles an hour, at 35 miles an hour, no accident is a good accident, but most likely at 35 miles an hour, it's not going to be a deadly accident. The market has been really, adaptive to the product developments that have come out as well. The third idea to take a look at is what are some of the buffered strategies that are out there. And what there is there's investments within the market that allow you to limit some of the losses or all of the losses that you have based upon using a buffered ETF strategy in exchange for having some type of capped return. So you could say, during the next 6 months, I'm a little bit worried because of the election, the things that are going on. I want to take a position that would help reduce if the market's down over the next 6 months and limit the losses. In exchange for that, over the next 6 months, there's a cap type return that we can have on there. Those buffered strategies are a good way that allows you not to let your human emotions of getting in and out of the market, which, a lot of studies have shown that's a very difficult thing to do. You can get whipsawed in a portfolio, allows you to stay invested. So if the market continues to rise, you can participate in, a percentage of those gains, where at the same time, if the market does have a sell-off, you can help reduce and or eliminate some of those losses. If you go through this fire safety drill that I'm talking about, the fourth thing that it's going to do for you, it's going to turn panic into opportunity. People get hurt when things catch on fire and they don't know what the exit strategy is. They don't know what the plan is. And I think we see that oftentimes happen with investors as well, meaning that they'll wait until the market has a major sell-off. They'll wait till things are bad. They'll take, big bruises in their equity positions, and then they'll ultimately, let their emotions get involved, or somebody talk them into making changes to more of a, fixed income type portfolio. Locking in those losses is going to be a painful lesson that too many investors make. But if you know what you own, if you run the fire safety drill, if you have, money set aside that you've already pulled out while the markets are at a high, what it's going to do is it's going to allow you to turn panic into opportunity. As we're discussing things with our clients and we're walking through these different strategies on how to kind of help protect them from market crashes and help them understand what they have in their portfolio. If you have these type of strategies in place, and again, on the nightly news, they're talking about the end of the world is here for the stock market. Mm-hmm. That could be a pretty good indicator for you that maybe it's time to, get together with your advisor and take a look at purchasing equities when everybody else panics. Again, think of investing as buy low, sell high. Markets are at record level highs. Now's the time to run that fire safety drill. This is something that we do all the time for folks. We'd be happy to run the fire safety drill and help you walk through integrating a downside risk management plan in place. So, if you're listening today and I ask you if and when the market has a major sell-off, what changes would be made in your plan, and you say, really none, or you're not sure, you're the type of person that should get together with us moving through these future economic uncertainties.
Because it's really not a question of when it's going to, or if it's going to happen. It's a question of when these market downturns are going to happen and how often over the course of your retirement. You're more than likely going to see more than one market downturn. But if you're positioned properly, if you know how to pivot and, see these panic moments and be able to make opportunities out of them. Warren Buffett famously said, you want to be fearful when others are being greedy and greedy when others are being fearful. It's easier said than done. You might need a little bit of discipline instilled on your side. Let the team at America's Retirement Headquarters help you through that, help you navigate whatever is coming down the line when it comes to the markets and volatility. And rest assured, there will be volatility over the course of your retirement, but hopefully you won't have to feel the effects or make those knee-jerk reactions. 419-794-3030 is how you get started, how you run that fire safety drill with the team at America's Retirement Headquarters. You can also reach out, find out more about them, and schedule a time as well at arhq.com. We appreciate you joining us today here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. 419-794-3030 is how you reach out. If you have questions about things we've talked about, you can also go to the website at arhq.com. Most baby boomers are going to enter retirement with their savings in a 401k, but maybe not for long. A recent USA Today article said, quote, our country would be a lot better off if the government abolished the 401k. Another one said the 401k is going to be gone in 10 years. The critics claim that people who've been able to save well in a 401k, they're in the top 10% of earners, which means that it is something that favors the rich, and the government loses $185 billion a year because they're tax deferred, and that money could be used to solve 75% of the problems that people may be aware of we're facing with Social Security. So, Nolan, you guys often talk about the tax time bomb that comes with the 401k. Would we be better off actually saving a different way? Well,
first of all, I think anybody who saves is a good thing. Mm-hmm. Saving for your future is important. I think relying upon the government to take care of us is not a good strategy. You really want to, be in control of your own future. If I look back at the older generations, like my grandparents, pensions used to be a common theme. And I think, that gave a lot of our grandparents peace of mind that they would work for a company for most of their lifetime, and then they retire and get a steady stream of income. And, it's called mailbox money, walk out and get their paychecks that's in the mailbox and enjoy retirement. And if they had a little bit of money set aside for savings, they could enjoy traveling and doing things. There's a lot to be said about that. And, us people that are 50 or younger, the transition's been to the 401k plans. And, what that means is that you need to take personal responsibility for your own future. And when you think about it and you think about what options are better than a 401k, a couple of things that would come to mind. One of the challenging things I think about a 401k is the account owner, meaning the plan participant at the end of the day, is ultimately the one that's responsible for making investment decisions. And I ask people when they come into the office, I'll be like, well, how did you pick the investment choice that you're in today? And, the answers range anywhere from, well, I looked at which funds did the best over the last couple of years, and I picked those to, I just picked the ones that are based upon a target date strategy. And I get it, because I realize that the financial planning and advice is somewhat detailed. It's no different than, I wouldn't be able to do what a doctor does. I wouldn't be able to do what a mechanic does in fixing vehicles. I know when I'm out of my realm, and a lot of these, plan participants, owners, they're out of their realm on making investment decisions. So it's no surprise that a 401k owner ultimately can get emotionally involved of trying to, get into the market, getting greedy when the market's doing well, taking abuse when the market goes down, and then making emotional decisions to make a change and get out. And that's why you see study after study have shown that a lot of the investors have underperformed overall. One of the things that we can do and help you out, if you have a 401k and your 401k has a value greater than $250,000, what we have is we have a technology platform that we can help out on your 401k, even wherever it's held at. So it doesn't have to be held by our company. What we can do is lean over your shoulder, take a look at the different investment choices that you have, and then tell you what we feel would be a way to kind of diversify your plan based upon your own individual situation. We can give advice based upon a strategic asset allocation. So again, large, medium, small, international stocks or bonds. And we can also give advice based upon a tactical perspective, meaning that based upon market conditions, tell you when to have more equities or when to be more defensive based upon how we look at the markets in a technical perspective. That software that we offer is called Plan Confidence. So if you need advice on your 401k, we can give you advice on your 401k. Even if you have a financial advisor, you're just looking for advice on your 401k, Plan Confidence, we can help you out with that. Now, when we're looking at your 401k and we're thinking about, how do I invest my 401k? Where should I be putting my investment savings at? First and foremost, I want you to think about matching contributions. Whenever there's matching contributions within a 401k plan, I want you to make sure that you're taking advantage of the full company match. So if they'll match you 50 cents on the dollar up to 4%, that means you should be putting in 8% of your income to be able to get the full company match of 4%. Anytime there's free money on the table, you want to take advantage of that. The second thing I want you to look at is, does your 401k offer Roth contributions as an option? The overwhelming majority of the people that we meet with today have money in the traditional tax-deferred 401k plan. And so what society has said, when you get older and retire, your tax rates will probably be lower, and so you should save money on taxes today. That way, when you retire and your tax rates are low, you'll pull money out. As somebody who's done this for 30 years, and I've helped hundreds of families, most of the people who are successful savers in their retirement accounts are out enjoying retirement time. Their tax rates are not lower than when they were working. And in fact, with the looming out-of-control government debt that we have, I believe that across the board, tax rates could be higher for most Americans that are out there. So what we've seen over the last couple of years is we've seen 401ks incorporate what is called a Roth 401k option. Mm-hmm. With a Roth 401k option, what that means is that you're not going to save the money in taxes today, but that money, if you follow the rules and regulations of how to set it up and when to withdraw the money, you have the potential to take that money out all tax-free. So it's a little bit easier when you're paying the taxes on the seed, the smaller amount, meaning the money that's going in, versus paying the big taxes on the harvest, meaning after 10, 20, 30, 40 years of growing a 401k. So Roth could be a good option in a 401k, depending upon your tax situation and your long-term goals and objectives. Number 3, does your plan offer what is called a self-directed investment plan? Many investors will come into the office and they'll show me their 401k and they feel like their investment choices are very limited and or they don't like their investment choices. So, in some of the plans, if you're limited or don't like your investment choices, some of these plans allow you to set up what is called a self-directed investment plan. Within the self-directed investment plan, you can take a chunk of your money in the traditional plan, move it in this self-directed plan, and that usually opens up a pretty large spectrum of different investment choices. So if there's something that you wanted to add in that's more tailored to your individual situation, that self-directed option in your 401k could be things to look at. Number 4 is a younger family. I remember being a younger family, when my wife and I were young and had kids. A younger family, still a good idea to save, but I think in a younger family situation, and by younger, I mean somebody in their 20s, 30s, and 40s, that younger family, may want to consider putting as much money into the 401k to get the company match, but instead of maxing out their contributions to their 401, maybe considering redirecting the money over the company match into permanent life insurance policy for a portion of their savings. When I look at the life insurance policy that I have, the reason that I have the policy is, God forbid, if I would have died young when I was early on, my family would have been protected with the tax-free life insurance death benefit that would have been paid out to my wife, allowing her to do things like pay off the mortgage or, have income to live off of and or get my kids through college. In addition to that, with my life insurance policy, I have what is called a critical and chronic illness rider. So if I get hurt, if I have a heart attack, if I get a diagnosis of cancer or had a stroke, or in that situation, it allows me to accelerate my benefits. If I have some type of terminal illness and my prognosis is I'm not going to live past 12 months, I have the ability where I could accelerate my business and, spend the last year doing what I want to do with my family and or getting my financial affairs in order. Or because of the fact that it's permanent insurance down the road, long time in the future, when we're thinking about things like long-term care and slowing down, I have the ability where I can accelerate my benefits. So permanent life insurance can be good, for a younger family, and it could be a good solution to kind of complement what's called the overall comprehensive plan. If no 401k Roth options are available, number 5 is consider opening a Roth IRA if you're eligible. That could be a good solution for you. So that could be 5 different ideas to do and things to think about when you're looking at your 401k. So again, if you have a 401k and it's been longer than a year since somebody has sat down with you and talked to you about individual advice. In fact, I have people that come into the office all the time that have told me they've never got individual advice, that they've had their plan as a set it and forget it approach from the time that they've had it. If you have greater than $250,000 in your 401k, you would really benefit from us having a conversation. Again, we can talk about using the technology that we have to help you make what would be a more informed investment decision. If you're worried about the markets and you want to incorporate circuit breakers, we can talk to you about downside risk management. And if you want to talk about the investment allocations and where to put the contributions as well as how much contributions, or if there are other options, we can kind of walk you through that approach easy. That's something that we do. That's, again, our area of specialty, and we'd be happy to go over it with you.
Just to reiterate, any money saved, any money put in towards a 401k or towards your retirement is great. That should be lauded. But if there are ways to make your money work harder for you, to make work better for you, more efficient for you down the line, when would you want to know about it? I would think as soon as possible. Maybe your 401k is great and you've got all these options checked off and you're set. But if there's a way, a tweak here and there where you can make it, more profitable for you down the line and less profitable to Uncle Sam, perhaps, I think it's worth taking a look at. And that is what the team, as Nolan said, day in and day out, that is what they do at America's Retirement Headquarters, is help people make sure they get to, through, and beyond retirement, keeping as much of their money as possible. It all starts with that phone call, 419-794-3030. Once again, 419-794-3030. You can always find them online at arhq.com. As always, want to thank you for joining us here on America's Retirement Headquarters. Hope you have a great week ahead of you. Hope you stay cool out there, stay safe out there. Nolan, always grateful for the time. As we wrap up here, I'd like to give you the final word.
Yeah, everybody just enjoy the beautiful weather, enjoy the great week. We'll be back next week, same time, right here on Toledo's largest talk station. And when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys Formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.